You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Hello, everybody. This is Kamyar Rezaie with Minds of Commercial Real Estate. Today we have Jarum and Tony Valte with Wilson & Hand. Thank you, gentlemen, for being on the show.
Thank you.
Happy to be here. Thanks, Kamyar.
Sure. So Jarum is a relationship manager with the company, and Tony is a tax strategist and also an attorney. And today we will be discussing taxes and, strategies and how to reduce taxes on different, depending how you file your taxes. Mm-hmm. So let's, Jarum and Tony, please, each of you give us a background about yourself.
Yeah, appreciate it. So I've been with Wilson Hand a little over 3 years. I'm a relationship manager. And so what I do is I help go out to basically all of the country, introducing the strategies that Wilson Hand, the law firm, has designed specifically to help offset tax exposure for clients. And I introduce these strategies to CPAs, wealth advisors, financial planners, advisors who have wealthy clients, the clients who are tired of paying high tax rates. And these strategies are designed to help their clients reduce that tax exposure. And we work with dozens of advisors across the country, hundreds of clients across the country. And Wilson Hand annually does $400 to $500 million worth of tax mitigation strategy work.
Thank you, Jarum.
Sure. And I'm Tony Valte. I'm a tax strategy director at Wilson Hand. I also have my own practice here in California the last 16 years, and it's always been in the tax mitigation space. And then I came to Wilson Hand actually to help in the income tax division, and it kind of expanded from there, helping individuals reduce their W-2 income or business income, anything tax mitigation related. I did went to Western Michigan University for law school and got my master of laws in tax from Boston University. So as soon as I graduated from there, I went into consulting, and well, here I am today, still in the tax game. It's a good industry to be in because Jarum and I help a lot of clients solve a specific problem that affects everybody, their taxes. And if you're not at least educated, Kamyar, to the audience, if you're not at least educated on your options, you're doing yourself a disservice. So it's always good to know your options out there, and you don't always have to pay those big taxes.
So today we want to, talk more in depth on, people that file on the ordinary income W-2s, K-1s, and what options are out there for them, because typically they're the ones who always, are complaining the most. You have a W-2 can be in, 6 figures, 7 figures. They have all these tax liabilities. And so they would always like to know what are their choices. And so if you gentlemen can speak a little bit further on that, maybe somebody who's filing a 250 to 300,000 return versus somebody filing let's say $500,000 to 700,000 return annually, and someone who's filing over $1 million return on a W-2 basis.
Yeah, great points there. I'll take this one, Tony.
Oh, no problem.
At Wilson Hand, our target actually is 800,000 or more in taxable income. And that can be in the form of W-2, 1099, K-1, as you mentioned, a few of those ordinary income options. We also work heavily in the area of capital gains. But I think for this topic, this call today, I think it would be good to focus on whether they've got W-2 or a form of business income. It is hard to find strategies for W-2 owners. Or W-2 employees, For business owners, it's a much simpler strategy to deploy, much more effective. But the reason we target individuals or business owners who are making $800,000 or more annually is because that puts them in the top federal tax bracket. And if they're in a state that has state tax that is on top of that. So our average client is taxed at over 40% because they're earning so much money. So it's a good problem to have, but a problem nonetheless. And generally speaking, our strategies are going to allow them to significantly reduce their tax exposure by reducing their income. I think with today's episode, maybe we can focus on our small home strategy, which can benefit a W-2 wage earner as well as a business owner, but in two different ways of doing that. So our small home strategy is very unique. When you hear the word small home, oftentimes people think this is a real estate strategy.
Right.
It is, but it also is not, because these small homes are technically portable. They're mobile homes. So they're not secured to a foundation, and thus they're not classified as real estate. And because they're not classified as real estate, they're classified as what we call a 1245 asset. And with a 1245 asset, we can harness bonus depreciation rules, section 168K of the tax code, as well as section 179 of the tax code. So I'll kind of take two different paths. A W-2 employee is going to go down a slightly different path with these small homes than a business owner would. And essentially for a W-2 employee, our law firm is going to create a micro business for that employee, an LLC. That LLC will acquire a small home. We'll use the bonus depreciation rules to accelerate the depreciation of that asset. And we can pass those losses, that depreciation, over to offset W-2 income. The way we do that is by turning that depreciation, that loss, into an active loss. So this strategy does require a client to participate in 100 hours of what's called material participation. And we could have a whole nother podcast on how we do that. But it is an important step in making that depreciation an active loss that flows through to the client's 1040 and essentially reduces their taxable earnings. So with that strategy, someone who has $800,000 of W-2 income, with one small home, we could reduce that $800,000 down to about $450,000 of taxable income. And that's where the magic happens. When they are now only taxed at $450,000, they're no longer in the top federal and state tax rates, significantly saving them on tax by reducing that taxable income. Now, a business owner, while similar, they already have a business. And so we still create an LLC for the business owner, but the business owner can use a section 179. And, most of us have heard the phrase a write-off. We're just taking a write-off. Well, a business owner can essentially write off the cost and the value of these small homes and reduce their taxable income. The 100 hours of material participation is still important because let's say the business owner owns a manufacturing company. Well, we're creating a rental business for them. So they would need to do 100 hours of participation in this rental business, but the depreciation and the business expense is substantial in year one for the business owner. So I'll just pause there. Kamyar, maybe before you have any questions, I'll make sure from the legal perspective, Tony can put me into check and make sure I didn't say anything out of bounds.
No, actually, you were right on. You were right on target. Obviously, there's the trade-off, and typically we always want to see, Kamyar, the income. If it's passive income we're dealing with, and they use a strategy like Jarum was just talking about, then there's not that burden of materially participating to kick it up to ordinary. But obviously, if it's earned income or any type of ordinary income, then there would be a little extra work. And, with our firm, Wilson Hand, definitely, we guide the clients on that. We just don't leave them up to their own Google researches and everything like that. We make sure that they understand exactly how to document the 100 hours and take advantage of it being ordinary. And just wanted to emphasize that part there, Jarum, but everything you else said was spot on.
Let me ask you a question in regards to if they're buying this, portable real estate. Or is this something that they would have to buy every year, or how many years can they use that depreciation, let's say on the first purchase?
Great question. So for a W-2 employee, we're generally attacking current year taxable income. We can't go back and adjust 2024 taxable income, but we can focus on 2025. For a W-2 employee, instead of being able to take the entire write-off in year one, we take a significant portion, over 52% of that write-off in year one, and then the remainder of the write-off will come over the next 4 years. But if that W-2 employee has the same taxable issue in 2026, they may want to acquire another small home or two and do the same thing. Each time we meet with a client, we get a very good understanding of where their income is coming from, what state they're in, what their tax exposure look like. We'll make a recommendation. We'll put together a financial model to help them understand the impact of the strategy. So for a W-2 employee, there's a little bit of a tail that pays off over time. For the business owner, it's a one-time, one-year transaction to wipe out their taxable income, and then they can rinse and repeat again next year, and so on and so forth.
So for the W-2 earner, let's say on the year two, they do buy another property. So they would get that 52% on the new property and the remainder on the previous year's property. So it kind of would reduce their taxes further, if I'm understanding correctly.
Well, that will depend on what happens with the Section 168K bonus depreciation rules. So this year we can take 52%. Next year, that may change. And in fact, this year in 2025, Trump is trying to get bonus depreciation back up to 100%. And if that happens, the W-2 employee will have the exact same benefit as the business owner. So we still have our fingers crossed that that will come through and pass the House and Senate this year. But until then, every year the tax codes will vary. So we just analyze it from one year to the next.
That would definitely be a big help if it goes to 100%. We are all looking forward to
And
that.
there's no dollar. Section 179, Kamyar, there's a dollar limitation. So, if you have $2 million in depreciation deduction and you're under Section 179, you can only deduct up to $1,250,000 of that this year, and the remaining balance, call it $750,000, has to use bonus depreciation. So it's at 52% right now, but if it went up to 100, keep our fingers crossed, speak it into existence. There's no dollar limitation with 168K. It's a percentage limitation. So, we're hoping that good things can still happen this year. If it can get up to 100% before the fourth quarter, that would be great for a lot of people out there and all of us, but definitely for the clients for sure.
Understood. All right. Well, that's a great strategy. I personally have not heard of it, and I've reviewed a lot of tax returns, getting loans, big loans, and I don't see a lot of this Section 168 depreciation.
Yeah, it's a pretty strong strategy. It's an excellent option. It's fairly bulletproof from an audit perspective. These are legitimate LLCs we're creating. These are physical assets. The client can track down their asset, go knock on the door. The nice thing about these, it's a physical asset. Really made this a white glove service. So we are helping the client acquire the asset. We provide private financing. It's not going to show up on their credit report or affect their lending abilities. we arrange the property manager, we arrange the land lease agreement, the electricity, the sewage, the cleaning, the furnishing. Everything is handled for the client aside from their 100 hours of material participation in this newly formed entity. But aside from that, this little micro business is very well streamlined, and our law firm has structured this to be highly compliant with the IRS codes.
And it's important too, because the risk in any tax mitigation, doesn't matter what strategy it is always in the event of an IRS audit or a state tax agency audit. So it's important for the tax agencies or the IRS to see that the business is real. The strategy is real. You don't want it to be go onto Google right now, and any of the viewers, and type in listed transactions IRS or the IRS's dirty dozen, and that'll give you the blueprint on what to stay away from. The strategies to stay away from. So IRS comes in and they see this strategy, they'll see that it's an actual business, it's an actual property, actual tenants, actual property management company, actual business and losses. And that's important in terms of the IRS, but also the comfort level, for the client too, because they do need to know the risks in a strategy like this, and it's always going to be in the event of an IRS audit. So it's important for them to know that.
Is there minimum annual income do you need to have in order to use this Section 168?
No, we try to target someone who has around 800,000 or more in W-2 or 1099 or K-1, or a combination of the two. We have business owners who are taking a W-2 salary of 250,000 and their business is profiting and distributing 750,000. So collectively, they have $1 million of income, or they have multiple businesses. So a collection of income that is around 800,000 or more is generally our qualifier. And when we meet with a client who's in that range of 800,000 or more, these become almost no-brainer options. And our calls are, our introductory call is a free consultation. We're not charging by the hour like a traditional law firm. We're here to educate a client, answer the questions on the strategy. We have multiple strategies. Hopefully, Kamyar, we can have another podcast and dive into a few more of these on the next couple of episodes.
Absolutely.
But there's certainly way more than we can explain on a 30-minute episode. But they are very powerful. They're very effective, very compliant. So we're trying to get the word out.
And one of the important things, Kamyar, for at least the viewers to understand if they do this is, even though the rental strategies do have the private financing that comes behind it, and the notes can be from anywhere from 10 years to 360 months, X amount of years. At year 5, we do have a exit strategy for them, a charitable exit strategy. We don't have them sell it, because then they'll have depreciation recapture. So we have our charitable companies in our network that would take the place of our client that we would work with. And that way they've donated their properties. The business is still going to run. The homes are still going to be rented, or the equipment's still going to be rented. So we want to make sure that that's still intact, but at the same time, have the client make a clean exit, because they got what they wanted, the deduction. But also at the same time, we don't want them to have any depreciation recapture. You sell it, that's going to happen. You donate it in the way that we structured it, no depreciation recapture. So again, this is all for the clients and education for them to know. It's better than not knowing.
Yeah, absolutely. One a more important question, which a lot of viewers would probably like to know, is what is the cost?
Sure, great question. This particular strategy will cost the client for one small home unit $750,000. but the package value is $375,000. So $75,000 out of pocket. Our law firm with that amount, there's no additional capital required into the future. It's a one-time transaction. We acquire the home, transport the home, furnish the home, set it up with property management, manage the cash flow. The cash flow is paying down the note. So the client is not expected to make any monthly payments. It's paying for itself. In fact, the client will see positive cash flow from day one from these assets. So there's a cash flow that's coming from this business, and we can sell multiple units. So one small home will cost $75,000. They'll get a $375,000 write-off. But if the client is making $800,000 or more, they may be looking at 2 or 3 units. If I just run the math here on my phone really quick, if we were to do 3 of these small home units, it would cost the client $225,000 out of pocket, but they would receive a $1.125 million Section 179 deduction to offset their business income. So if they were making 1.2 million, they would almost bring their tax exposure to 0.
Yeah.
In this example. But that's where, we have that discussion of how much income do they have? What's their taxable situation? Are they looking to eliminate all of it or a portion of it? And, what their interest level is in 1, 2, or 3 of these small homes. And again, we have a few other strategies that might be a better fit for individuals making 2 million or more. We have clients that make $2 to $5, $10 to $20 million annually. We have different strategies that might come into play that would be a better fit than a small home.
And a good way to see it, at least for the viewers and clients, how it benefits them is Jarum was just saying, let's say a client bought 3 homes for $225,000. Yeah, it sounds like a lot, right? $225,000. But remember, they're getting the $1,125,000 deduction. So what happens is, let's say a client makes $1,125,000 for the year, even at 37%. We won't even use state taxes, right? So $1,125,000 times 0.37, it's $416,000. $250,000. If they do nothing at all, no planning, that's what they're paying in tax, just federally. If you're in California, like my state, or where your state, Kamyar, they're paying 50%. Yeah, so now instead of paying that amount, they're paying $225,000 to wipe out the entire gain, but their net savings is going to be whatever their tax liability is. Say 416,000 less the 225. When you're making a $1.1 million, 200,000 in savings, 300,000 in savings is absolutely huge. That's money that's lost. Now it's money that's found and kept, and time value of money. What you can do with that extra money that you weren't going to have had you not met with Jarum and myself and everyone at Wilson Hand.
All right. Appreciate great information. Thank you, Jarum. Thank you, Tony. What's the best way the viewers can get a hold of you guys?
Your audience knows how to contact you, I'm assuming. They're always welcome to reach out to you, and you can get them in touch with us. But they can also reach out to Tony and myself. Maybe you can put this in the podcast notes, Kamyar. Sure. But it's just our first name, last initial at wilsonhand.com.
We'll put that in the footnotes. Absolutely.
Very good. Love to speak with anyone who has any questions, and looking forward, Kamyar, to another podcast and diving into a few other options.
Absolutely. Thank you guys both for your time.
Thank you, Kamyar.
Pleasure.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. together. Let's get together.